Thank you for joining us today. We're going to pause just a moment to allow others to join, and then we'll get started. Welcome to Master the New Tax Law for Client Conversations, brought to you by IREAP, NAIFA's Investment, Retirement, Estate, and Advanced Planning Knowledge Center. During today's broadcast, I invite you to type your questions into the Q&A box on your screen. You may do this throughout the broadcast, and from your questions, NAIFA will be producing a frequently asked questions document. It is now my pleasure to introduce NAIFA's Senior Vice President of Government Relations, Diane Boyle.
Thank you, and thank you for joining the webinar. I'm really excited to be here with one of our outside counsel, Nick Sutter from Steptoe, and Kathleen Bilderbeck, who is a trustee on NAIFA's board, to walk through not only what the new law actually does and some of the provisions in detail, but how you can actually utilize those provisions to start conversations with your clients. I would love nothing more to say that our advocacy work here is done and that we're handing it over to practice management and client communications and practical application of the laws. But the reality is that there will be guidance needed from Treasury and other information in order to see how some of these provisions really play out. So some of them were put in place at really a high level, and we need to dig down a little deeper. Part of the survey, when you're done, we ask what you would like to talk about in our next webinar. We anticipate that this will be a series, so let us know your thoughts. It's simple questions. There's a check-a-box, and you can also write in if there's a topic that we didn't sort of tip up for you that you'd like to hear more about. But before I turn it over to Nick and Kathleen, let's take a look at the road. How did we actually get here? And we actually start with the House passage of H.R. 1, but in reality, our work started way before this. And when I say our work, I truly mean the work of the NAIFA member as well. We started in 2017 knowing that some of those provisions were going to expire, and that we needed to make sure that members of Congress understood the role of our industry and our products and what some changes or modifications would do to access to both products, services, and the affordability of access to those. So those conversations started very early on and then continued throughout different election cycles. So we had new members of Congress that came into play, and they needed to be educated on our issues too. So it was a constant drumbeat of making sure that we had those relationships developed, that information shared, so that our lawmakers could make educated decisions when faced with some of the challenges that they have. One of the ways, literally 2 days before the House passed its version, NAIFA's congressional conference was held on May 20th. We had members from across the country come in, and then 2 days later, the House passed its version. Senate then releases its draft, and we go all the way through. I'm not going to go through each of the steps. You see them here on the screen. We have enactment with the president signing H.R. 1 into law. So let's talk a little bit about what wasn't included, because I think very often our legislative wins are what we keep out of becoming law rather than what we put into law. And there were a number of challenges that we had, despite all of our efforts of educating members of Congress and their staff prior to going into this provision or this law that actually consumed the last 6 or 7 months of our lives on the government relations side of things to go through all of the different provisions. But by and large, there isn't any change on the tax treatment of our products, whether in the life insurance space, retirement incentives, group health insurance. All of those were talked about with possible changes. and we got through without having any of the changes there. There were discussions about having changes to carried interest rules, and that didn't come to fruition. There was also talk about looking at implementing some type of corporate, state, and local tax deduction changes. And what that would do in our industry, as all of you know, would be very detrimental to those that operate as pass-throughs. And because the insurance industry in particular pays premium taxes in the states, it was an additional challenge for our industry, in addition to other industries as well. That was not included in the final law. And there was also a discussion about a new top individual rate, and that didn't come to be. So that sort of sets the stage of how we got here, what's not included. And now I'm going to turn to the experts. And actually, I two highly acclaimed, well-recognized individuals on this subject matter. And, Nick, let's go ahead and I'm going to shift to you and we'll talk about some of the individual provisions. If we can advance a little bit, and then once we get through those, we'll take a break and hear from Kathleen. There's more than on this slide in the individual section, but let's get through this section, Nick, and then we'll.
Sounds good. Thank you for having me, and thanks to NAIFA as well. So just starting on the individual tax side, the new law permanently extends the TCJA's reduced individual tax rates for all taxpayers, and it maintains that top rate at 37%. As we just mentioned, there is no increase to going back to a 39.6% top rate. There's no new taxes on income over $1 million. All those had been talked about kind of in the few months leading up to the tax bill, but none of that was included in the bill. The new law also permanently extends the increased estate tax exclusion at the $15 million level, and it indexes that amount for inflation each year. So it's going to go up likely each year, and that is $30 million for married taxpayers filing jointly. Without these changes, the state tax exclusion would have gone back to $5 million starting next year. And then one of the most kind of hotly talked about issues over the last few months when Congress was looking at this tax bill was the SALT tax, the state and local tax deduction. And the new law raises the SALT cap from $10,000 to $40,000, but only for taxpayers with income less than $500,000. For taxpayers with income more than $500,000, the SALT deduction phases down gradually to go back to that $10,000 SALT cap. This new $500,000 income cap and the $40,000 SALT cap are set to go up 1% each year, but this is only temporary. So the SALT cap is set to return to $10,000 again starting in 2030, and likely we'll see probably the same issues in Congress again when the SALT cap expires. And then last, the new law also includes several of President Trump's campaign proposals that would exclude certain types of income from tax. So this includes the things like no tax on tips, no tax on overtime pay. These are all made part of this new law. But unlike the individual tax rates and the state tax exemption, these provisions are only temporary, and they're set to expire at the end of 2028, which also happens to line up at the end of President Trump's term. For no tax on tips, the deduction is up to $25,000 for qualified tips in a regularly tipped industry. And there are certain restrictions in the bill that exclude, certain industries from saying that, certain payments are considered a tip. So that's going to be an area, as Diane was talking about, there's going to have to be a lot of rules implemented around how the no tax on tips works. And similar for no tax on overtime pay. So the new law provides a deduction of up to $12,500 and $25,000 for taxpayers filing jointly for qualified overtime compensation. And the law makes reference to what qualified overtime compensation is in the National Labor Relations Act. And then both the no tax on tips and the no tax on overtime are subject to strict income limits. of $150,000 or $300,000 for taxpayers filing jointly. And these tax benefits phase out as the taxpayer's income goes up. The new law also includes a new $6,000 deduction for seniors over the age of 65. And this was something that President Trump had talked about. He had floated during the campaign that there would be no tax on Social Security income. So this kind of operates in a similar fashion, but this deduction is only available for taxpayers with income less than $75,000 or $150,000 if you're filing jointly. And while, it changes, it has a similar effect to no tax on Social Security income, but the new law actually does not change how Social Security income is taxed. And then there's also a new deduction for car loan interest payments. This only applies to personal use vehicles, and the deduction's limited to $10,000 a year. And the vehicle also has to have its final assembly here in the United States to be able to be eligible. This similarly has a phase out when the taxpayer's income exceeds $100,000 or $200,000 for joint filers. So these are a lot of things that President Trump had talked about during the campaign, and these are some new tax provisions that made it into the final bill. And that I'll turn it back over to Kathleen to talk a little bit about what this means.
Thanks, Nick. I appreciate that. So just a reminder, what do we mean when we say the top tax bracket? So for 2025, that's single filers who make a little over $600,000 a year, or for married filing jointly, it's a little bit over $730,000 a year. And the reason I'm reminding everybody of that is as we go through these changes and conversations that I'm having with my clients, a lot of the changes that we're going to talk about affect people in those tax brackets. So those are important numbers to sort of keep in mind. On the SALT deduction, I've gotten a lot of questions from clients about this. First of all, nobody is worse off. The floor of the deduction remains at $10,000, but temporarily, and that's another thing to watch out for, is the effective dates and the expiration dates for some of these changes that will expire. Some taxpayers, and again, here we're talking about gross income less than $500,000. So we have all these different limitations, which can be a little bit confusing for clients. So some taxpayers will get a temporary increase in their SALT deduction. The big news, of course, for me is the permanent increase in the estate and gift tax exemption. So everybody on the call knows that permanent in tax law is only permanent for a while, but I think it's given clients a lot of certainty about what's going to happen at the end of the year. It's made clients more confident about moving forward with plans that they have already made and making some new plans. So let's talk about some questions that I've gotten from clients about this particular change. First, did the GST exemption increase? Everybody's talking about the increase in the estate and gift tax exemption. They're not talking about the increase in the generation skipping transfer tax exemption. Yes, that exemption increased as well because it incorporates the estate and gift tax exemption by reference. So the GST exemption also went up under this bill. It will go up beginning January 1st, 2026. Second question, portability. I've had a lot of questions about portability. Portability is not affected by the changes in the tax law. Remember that the estate and gift tax exemption is portable. The GST exemption is not. Another question I've gotten, does this affect the gift tax annual exclusion? No, it does not affect the gift tax annual exclusion. The gift tax annual exclusion actually was indexed for inflation under a different tax law in 1997. So the gift tax annual exclusion for 2025 remains $19,000 per beneficiary for gifts made in 2025. So whenever we have permanence, some clients become procrastinators. They were planning on using their estate and gift tax exemption before the end of the year, before it was reduced, as Nick said, to $5 million index for inflation. Now it's permanently extended to $15 million per person. That has caused some clients to put on the brakes. What I tell those clients is, if you make the gift now, you are not only getting the amount that's gifted out of your estate, but you're also getting future appreciation out of your estate with no additional transfer tax implication. In addition, we're still using a lot of grantor trusts. So if assets are gifted to a grantor trust and the grantor is paying income tax on the income generated by those assets, that's an additional gift to the beneficiaries, which is not subject to transfer tax. So what are some of the projects on my desk right now? Well, it's interesting because in what I do, a lot of types of projects come in waves. And one of the things I've been working with a lot of my clients on unwinding old gifts, particularly old family limited partnerships. And let me tell you how that ties in with this tax change. I'm working with one client whose wife died in 2011. She had an estate, a taxable estate of about $3.5 million. At that time, the exemption was only $5 million. She'd made about $500,000 worth of gifts during her lifetime. So in 2011, we did have portability. He carried forward $1 million worth of her exemption. Included in her estate was a 50% interest in a family limited partnership that they had set up. Husband ultimately gifted in 2012 49.5% of that limited partnership to an irrevocable trust. Well, as you can well imagine, since 2012, that family limited partnership, the assets have increased in value precipitously. So what we are doing with that client is unwinding the family limited partnership and distributing the assets to the partners. So 50% of those assets will go into a credit shelter trust, which benefits husband and their descendants. Then when the assets hit the credit shelter trust, we are distributing about $4 million worth of assets to the husband so that those assets can get a step up in basis when he dies. So that, combined with swapping assets with the grantor trust, is going to save the heirs over $1 million in capital gains taxes when my client passes away. Another thing that we're working with clients on the new exemption, the increased exemption, one of my clients who has a very large irrevocable life insurance trust, which takes not only all of his family's annual exclusions to fund, but also significant gifts each year. We are working with him and his spouse. They are going to transfer assets to the ILET, probably January 1st, to fund the ILET indefinitely. That trust is taxable as a grantor trust, so it will be funded with income producing assets, which will pay the premiums on the life insurance contract going forward, and will also, additional income will be available for other investments. Meanwhile, the income is being taxed to the grantor and his spouse. So by paying that income tax, they are making additional non-taxable gifts to the trust beneficiaries. So those are just a couple ways that we are working with clients on the increased exemption. A reminder to everyone, I have been getting a few calls about clients and their life insurance contracts. Perhaps the client feels that they don't need the life insurance coverage that they have based on the increased exemption. Well, my first response is, I've never known a beneficiary who complained about getting cash after somebody died, but In addition to that, remember all the changes that we're talking about today are federal changes. There are still plenty of states that have an estate tax or an inheritance tax. I am licensed in Missouri, Illinois, and Pennsylvania. Missouri has no estate tax. Illinois has an estate tax with an exemption of only $4 million per person, and Pennsylvania has an inheritance tax. So there are plenty of reasons to keep that liquidity in place. Also, for example, my client with a family limited partnership, if we were not doing this dissolution and distribution of assets, those assets would have a tremendous capital gain that's built in when they pass to the descendants. Somebody has to have money to pay that capital gains tax when the assets are sold. So keeping the life insurance in place in the estate has many more uses than just paying federal estate tax. Plus, as I said at the beginning, permanent in tax law is not as permanent as you think. Thanks.
Yeah. Truer words have not been spoken, Kathleen, on the permanence. Permanence until Congress acts again. But at least it doesn't have an expiration date tied to it. So it does give a little more certainty until Congress actually comes up with a change of some sort. So Nick, let's flip, keeping with the individual provisions, but let's talk a little bit about charitable deductions and some of the limitations on itemized deductions as well.
Sure. So the new law really changes how the charitable deduction operates. And it both, in one way, expands it, and also another way puts new limits on it for certain taxpayers. So on one hand, it makes it more generous by allowing taxpayers who don't itemize, who otherwise wouldn't be able to use the charitable tax deduction to file for an above the line deduction of up to $1,000 annually, or $2,000 if they're filing jointly. And this was a temporary policy that was enacted during COVID, and it has been expanded and subsequently now made permanent. And with the TCJA and in this new law upping the standard deduction, less taxpayers are itemizing, and they're not able to haven't been able to benefit from the charitable deduction. So that's one of the changes that this law is making to make the charitable deduction available to more taxpayers out there. But on the other hand, the new law also changes the deduction for taxpayers who itemize and for businesses as well. So for taxpayers who itemize, the charitable deduction is only allowed to the extent that the contributions exceed 0.5% of their taxable income for that year. So for example, a taxpayer with $300,000 in income would only be able to deduct the amount of their charitable contributions to the extent that they exceed $1,500, because that's that 0.5% threshold. And there's a similar restriction for corporations as well. So the charitable deduction for businesses is only allowed to the extent that their contributions exceed 1% of their taxable income. And the bill keeps the current 10% limit on charitable contributions on the high end. So just as another kind of simple example, for a corporation that has $10 million in taxable income, they could only deduct their charitable contributions to the extent that they exceed $100,000 for that year. And then on the high end, any contributions that exceed $1 million for that 10% cap, they would not be allowed. The one thing to note on this is, though, that these changes are not effective until the 2027 tax year as well. And then just going to the next slide, we can talk about the new limit on itemized deductions as well. So the new law puts a limit on the amount of itemized deductions for taxpayers in that top marginal tax bracket, that 37% tax bracket, over $600,000 a year in income that Kathleen was talking about earlier. And it effectively caps the itemized deductions at the 35% value rather than the current 37% tax rate. And it does this by making the taxpayer do kind of a weird calculation, but the amount of their itemized deductions will be reduced by 2/37 of the lesser of the total amount of their itemized deductions or the income greater than the dollar threshold of the 37% tax bracket. But it's just effectively putting a cap at 35% on the value of their of the itemized deductions. But note that this does not apply to the 199A qualified business income deduction for pass-throughs that we'll talk about here in a little bit. But we'll turn it back to Kathleen to talk about, what this actually means in practice.
Thanks, Nick. So this is bad news for taxpayers in a way, and it's bad news for charities. With this new limitation, Nick gave you an example. I'll give you another example. Let's say we have a married couple and they have taxable income of $750,000. They can only deduct charitable contributions that exceed $3,750. So there is a limit on what they can deduct. And that limit, this is one of those places where it makes sense to look at the effective date, is December 31st, 2025. Now, I know a lot of the people who are participating in this webinar are probably on charitable boards like I am. And in St. Louis, where I am physically located, we have a lot of capital campaigns going on right now. If we have clients who have made a pledge to those capital campaigns, they may want to consider paying that pledge prior to the end of this year so that they will not be subject to that limitation. In addition, we have a lot of clients who are thinking about donor advised funds. Donor advised funds, obviously, if you put the money in 2025, it counts as a public charity, so you get a higher deduction and it will not be subject to this limitation. So for clients who give amounts over time, it may make sense to fund a donor advised fund this year to get the full tax deduction, and that will enable them to continue giving every year. Those are probably the two biggest conversations that I'm having, both with my charities and also with my donors. The other conversation is with corporations. A lot of the big charities around here, and the small charities too, rely on corporate deductions to fund their activities. Corporations now will have until the end of 2026 to maintain that 10% limitation without the 1% floor. So again, I think for the charities, they will be going out to a lot of the corporations who are funders of, let's say, their season or their various activities, and seeing if there are ways to convince the corporation to accelerate a pledge, perhaps, so that they can take full advantage of the deductions that are currently available. And this limitation that is on this slide, I think that a lot of taxpayers don't realize that this is even out there, because obviously professionals are still digesting the changes made by the tax law. But not only do we have the limitation on how much taxpayers can deduct, we also have the limitation here on itemized deductions as a whole. So I think this is going to be something that is talked about a lot more as people start to really dig into the tax changes. One other thing I did want to mention here, and that is the tax bill also included a change to section 4960 of the code. That is a tax on excess compensation paid by charities to what used to be only their covered employees, which was defined as the top 5 executives of charities. and it imposes a 21% excise tax on compensation generally in excess of $1 million. The change that this law made is that the definition of covered employees is expanded to include not just the top 5, but all employees and former employees. So where you have a charity as your client, or where you have an executive of the charity as your client, and perhaps they have a non-qualified deferred compensation plan of some sort in place, this limitation may now apply to them, this excise tax, where it would not have applied to them previously.
A lot to digest there, Kathleen. Good information. Nick, let's shift and talk about what I like to call the opportunities for kiddo savings.
Yeah, absolutely. And the new law makes some pretty significant changes to the 529 educational savings accounts, and also it also makes these new savings accounts, the Trump savings accounts. And just starting with the 529 savings plans, these are tax advantaged saving plans that are designed to encourage saving, for future educational expenses, both at the elementary and secondary school level as well as for college. And the benefit is that they provide for tax-free distributions if they're being used for a qualifying educational expense. And the new law expands 529 plans to be used for credentialing, licensing, continuing education programs that are at the post-secondary level. So certain things like apprenticeships, and you can also now use 529 plans for exam fees for licensing and other skilled training certifications. And then at the elementary and secondary school level, previously 529 plans could only be used to cover tuition costs. But the new law expands these eligible expenses to include fees that are related to tutoring, certain standardized testing fees, online education, certain other educational books and other curriculum information that you're purchasing. And it also increases the per child cap for elementary and secondary school expenses. Previously, you could only spend $10,000 for each child out of a 529 account annually. The new law ups that to $20,000 for each child annually. So a pretty significant jump for elementary and secondary school expenses. Turning to the new Trump accounts, these are new accounts that allow for contributions up to $5,000 annually from a child's parents, relatives, or even the parents' employers. This is a new federal policy. It's intended to promote savings starting at an early age. And these accounts must be established for a child who's under 18 years old. They have very strict rules on investments and how the money can be invested within the account. It can only be invested in qualified index funds like the S&P 500. The distributions from the account are not allowed until the child reaches at least 18 years old, and then they'll be taxed just at the ordinary income rate. In terms of an employer, they can add up to $2,500 into these accounts, and that counts towards that $5,000 limit, and that'll be excluded from the employee's income for that year. There's also a new pilot program that's gotten a lot of interest, and there's been a lot of interesting press stories about this. But for children born between 2025 through the end of 2028, the federal government will provide a one-time $1,000 contribution to seed these new Trump accounts. There were a lot of changes that occurred when these provisions were being written in the House and Senate. This is another area, I think, where there's going to be a lot of regulations that the Department of Treasury and IRS are going to have to issue to actually to kind of implement how these accounts are going to actually work. And then just going to the next slide on the able accounts, the law also makes some pretty significant changes to make permanent a lot of the temporary provisions that have been in law the last few years related to able accounts. Just in general, able accounts are similarly tax advantaged savings accounts for individuals with disabilities that lets them save money without losing eligibility for other means tested federal benefits like Medicaid. And similarly to the 529 accounts, the distributions are tax-free if they're used for certain qualifying expenses such as education, housing, transportation, or other just living expenses. And the new law makes 3 key changes to make permanent some provisions that were set to expire. First, the annual limit for the able accounts is equal to the federal gift tax limit, which, as we mentioned earlier, is currently $19,000. The new law makes permanent additional contributions for persons who are employed and lets them add more money to these accounts up to the lesser of either the federal poverty level for one person household or the beneficiary's compensation for that year. So it's a way to incentivize some additional contributions into these accounts. And the new law also permanently allows beneficiaries who are making qualified contributions to their ABLE account to qualify for the Savers tax credit. And this is just a tax credit that that is available for contributions to certain retirement accounts if the persons are under a certain income level. It's kind of as a way to incentivize saving. And last, the new law permanently allows tax-free rollovers from 529 accounts into ABLE accounts as well. And the new law also makes a few changes to health savings accounts. And so before the One Big Beautiful Bill Act, most of the Affordable Care Act's bronze and catastrophic plans did not qualify as a high deductible plan that could be linked with an HSA. Under the new law, the ACA's bronze and catastrophic individual plans are now part of and included in the definition of an HSA compatible high deductible plan. So as a result, people who are purchasing these plans can now also have an HSA to come along with these plans. And the new law also provides that a high deductible health plan will not fail to be treated as a high deductible plan if it offers telehealth services. And these changes are effective beginning at the start of next year. And I can turn it back to Kathleen and Diane as well to talk a little bit more about these.
Thanks, Nick. So first I'm going to start with when we were looking at what to talk about on this particular webinar. We only have an hour. And as Nick mentioned, the changes to the ABLE Act are so significant that we have already decided that IREAP is going to sponsor a separate webinar just about those changes. So if we could go back to the prior slide, I do want to make a couple comments here on the 529 savings account expansion and the new Trump savings accounts. So first on 529 plans, remember that a lot of states give income tax deductions, state income tax deductions for contributions to 529 plans. There is no limitation on how long that money has to stay in the plan before it can be used for expenses, qualified expenses. So I have a lot of clients who will contribute to the 529 plan, take the tax deduction to the limit that Missouri allows, and then turn around and use that money immediately to pay tuition. The expansion of the 529 savings accounts is pretty exciting. And speaking as a parent, with one child who just made it through college and the other one who is still in college, it has a lot of meat in it. First of all, the increase in the limits on what can be spent for K through 12 education. I think somebody must have looked at what private school tuition and parochial school tuition is costing these days, because that was definitely needed. Also, everybody who's ever had a child go through any type of private educational program knows that it's not the tuition, it's all the other things. So all the books, all the materials, all of that, this expansion will cover. I want to talk also about the qualified credentialing experiences or expenses. As I mentioned, I have two sons. The older one was lucky enough to get a scholarship to college, so he still has money in his 529 plan. If you remember, in January, I believe, of 2024, the law became effective that $35,000 could be rolled over from his 529 plan to a Roth IRA, tax-free. So for the child that got the scholarship, that's a great option. And a lot of clients don't even realize that that provision is law. For my younger son, he is taking a lot of courses in cybersecurity and getting a lot of certifications. So now, in addition to being able to pay those college expenses that he has, some of those credentialing expenses will be able to be paid through his 529 plan. So it's pretty exciting, even though it's just a small piece of this presentation. On the new Trump savings accounts, that's pretty exciting too. And if you have been waiting for an incentive to have another child, that $1,000 is waiting for you. We just don't know where or how it's going to be paid. I can tell you some of the states obviously have similar programs on a smaller scale. For example, Illinois has a $50 contribution that they will make to an Illinois resident child's 529 plan. But that $50 has to be held in a separate account from the account that the parents or the grandparents are funding. So it's really exciting that these Trump savings accounts are in the law, much like when we had the qualified charitable distributions, where people qualifying taxpayers could make distributions directly from their IRAs to charity. Now we have a law that nobody knows how to administer. So stay tuned and let's see what happens with the Trump savings accounts. And now I think back to Diane so we can talk about some of these.
Yeah, well, Kathleen, I share your excitement over the 529 changes, having my youngest son announce after 2 years of university that he wants to become a pilot. Flight school until July 4th was not covered, but now is. So we're excited to have that opportunity to utilize the funds that way. Nick, let's go ahead and jump into business provisions, and we'll shift gears a little bit and talk about some of the changes there.
Sure. So similar to the individual provisions, the new law also permanently extends several of the Tax Cuts and Jobs Act's expiring or already expired business provisions. First up are the research and development provisions. So starting in 2022, businesses could no longer deduct their R&D expenses, but had to amortize those costs over either 5 years for research that was happening in the US or 15 years for foreign research and development. This was set up as an offset in the Tax Cuts and Jobs Act to raise additional revenue, but many businesses were arguing that this has increased the cost of investing, increased the cost of capital to help finance, to make investments in new projects. So the new law permanently restores immediate expensing for domestic R&D expenses, but maintains that 15-year amortization period for foreign R&D. For certain small businesses that have annual receipts of $31 million or less, these provisions apply retroactively. back to 2022. Next up is the 100% bonus depreciation provisions. The new law extends the bonus depreciation for qualified property that had been set to previously phase out. It's effective for qualified property that's placed in service after January 19th, 2025. And the new law also temporarily provides 100% expensing for qualified production property and this is only for property that begins construction after January 19th of this year and before January 1st of 2029 is placed in service before January 1st, 2031. And qualified production property is defined as just non-residential property that's used as part of a production activity. So manufacturing, production, or refining of tangible property. So it's generally the property that's part of a manufacturing process or other production activity. The new law also returns to a more favorable calculation for the business interest expense deduction under Section 163J. So the TCJA put a limit on business interest deduction to 30% of adjusted taxable income. And it's been defined two different ways. So from 2018 to 2021, adjusted taxable income was defined as earnings before interest, taxes, depreciation, amortization, or EBITDA. From 2022 and on, it was defined as just earnings before interest and taxes. So taxpayers that were subject to depreciation and amortization costs, they had to keep these costs out of figuring out their adjusted taxable income. So the new law returns to the more favorable 30% of EBITDA standard and essentially is providing a larger business interest deduction. There are they tightened up some of the rules if you have income from a controlled foreign corporation that you have a little bit of a smaller deduction because that's not part of the adjusted taxable income definition. One of the NAIFA priorities and others kind of that have been focused on 199A. This law, it permanently extends the 20% pass-through entity deduction for qualified small businesses. So this provision was put in place to try to equalize the reduced tax rate for businesses to line up with the rate that pass-throughs pay at the individual level by providing a 20% deduction. The House bill would have raised this to 23%, but the enacted version kept that 20% deduction and made it permanent. The bill also keeps certain restrictions from a specified service trade or business that they don't qualify fully for the deduction over certain income levels. The new law also permanently extends the excess business loss limitation as well for non-corporate taxpayers. So with that, I'll turn it back to Kathleen again.
Well, obviously, the big news for most of my clients is what was and wasn't in Section 199A. Some of my clients obviously were hoping for a higher deduction, but I think everybody is thankful that it did not go down or be eliminated. So there's going to be a lot. I think I didn't realize that there is a big dislike of Section 199A among some of our CPA friends. They think it's complicated, and it is definitely complicated. I agree. There are some new provisions, more expanded provisions in the version of Section 199A that was just passed. But what it did not do is expand the definition of who it will apply to. So service businesses, unfortunately, are still limited under Section 199A. And I think that's something that a lot of my clients who are service providers are a little bit disappointed about. But again, I think Section 199A is going to be one of the topics that we cover in a future webinar sponsored by IREAP.
Great. Nick, let's dive down a little bit deeper and talk about small business provisions in particular.
Yeah, sure. So there's also some big changes that will impact small businesses. One is Section 179. So Section 179 allows taxpayers to expense up to $1 million of qualified property that's placed in service in each taxable year, subject to a phase out to the extent the cost of the property exceeds $2.5 million. So the new law raises both these amounts for property placed in service after 2024, and it allows the taxpayer to expense up to $2.5 million of property that's in service and subject to that phase out to the extent the cost of the property exceeds $4 million. And each of these amounts are indexed for inflation each year. There are also some favorable changes that were made to the qualified small business stock exclusion for qualified stock that was acquired after 2010. The taxpayer can exclude 100% of the gains from the sale of this qualified stock, but they must have held on to that stock for at least 5 years to be eligible for this benefit. It was kind of an all or nothing kind of benefit. And the new law creates this new tiered structure that provides for a lesser exclusion if the stock is held for a shorter time period. So if it's held for only 3 years before the sale, the taxpayer can exclude up to 50% of the gain. If it's held for at least 4 years, the taxpayer can exclude 75% of the gain from income. So also under the current law, taxpayers per issuing corporation gain exclusion is limited to the greater of $10 million or 10 times their original basis in the stock. Under the new law, that cap is increased to 15 million. The current law also looks to the corporation's gross asset basis. It has to be under a certain threshold at all times during the corporation's existence through the period immediately after the issuance of the eligible stock to allow that qualified stock to be eligible for this preferential treatment. And the new law increases that cap from 50 million to 75 million. And each of these changes now applies to any qualified stock that was acquired after the date of enactment of July 4th of this year. And with that, I know Kathleen will have a few things to say on these as well.
So these are probably, Nick, the two most exciting parts of the small business provisions for my clients. First, the enhancing of the expensing under Section 179. Clients are going to pay less tax. If they're paying less tax, they have more cash available in their business for other things. For example, I have a lot of clients who are right now looking at SERPs, supplemental executive retirement plans, for their top executives. They have more money to work with. This Section 179 expansion can be used as a conversation starter about putting some of those non-qualified deferred comp benefits in place for the executives, or split dollar arrangements for their executives. So from my perspective and from my client's perspective, this Section 179 is a pretty big deal. The other thing that is a very big deal and is probably one of the best kept secrets of the Internal Revenue Code is Section 1202. So as Nick said, Section 1202 allows an exclusion of the gain on the sale of stock if the corporation meets the qualification requirements. That is a very big deal. And as soon as clients find out about this, they're very excited. So I just want to mention a couple things that are not on the slide, because every week or so, somebody calls me, they've read something online about section 1202, and they want to figure out how they can use that to either exclude the gain on the sale of their company, or perhaps use it in a negotiation with a shareholder about buying their stock. So here are a few things that all the advisors need to know that are not on this slide. First, it has to be a C corporation. It only applies to C corporations. Yes, your client can convert from an S to a C, but if they do that, they're not going to be able to immediately take advantage of section 1202. They have to meet the holding period requirements. Also, the stock has to be original issuance, which means that it has to be stock that was issued by the corporation. So let me give you a specific example. I'm working with a client right now. He and they had 3 shareholders originally. One of them passed away. They bought the deceased shareholder stock from the deceased shareholder's estate. Now my client wants to make an offer to his co-shareholder to buy him out. And one of the points that we are making in our offer is that part of his stock will be excluded. The gain on the stock will be excluded under section 1202. Well, only part of it is excluded because part of it is original issuance, meaning it was issued by the corporation when the three shareholders began the corporation. But the stock that they acquired from the shareholder who died will not be able to be qualified under section 1202 because it's not original issuance. The other thing that I need to point out is there are a lot of limitations, even if you're a C corporation, even if you meet the holding requirements. There are a lot of limitations on service businesses being able to avail themselves on section 1202. So, if you are a law firm, an insurance firm, a financial advisory firm, all of the things that one thinks of under section 199A, those types of businesses may not qualify, even though they're C corporations, and would otherwise qualify for the exclusion of gain under section 1202. One of my colleagues here at Sandberg Phoenix, Becky Woltman, and I work on a lot of these section 1202 transactions. She is a real expert, and I know that she, like me, is absolutely giddy about these changes in section 1202. So
there
it's a
are people that get giddy over this new tax law, but I'm glad that you're among friends here and we're giddy as well. Nick, let's talk a little bit about some of the workplace benefits, and we'll wrap this up.
Yeah, sure. So the first change is to the employer provided childcare credit. So the current tax credit provides employers with a 25% tax credit for their qualified childcare expenses, but it's capped at $150,000 annually. So the new law raises this tax credit from 25% to 40% of their qualified childcare expenses, and it increases the maximum credit to $500,000 or even higher, up to $600,000 for eligible small businesses with less than $25 million in annual receipts. And each of this $500,000 limit or $600,000 limit is adjusted for inflation going forward. And also, the new law also makes some changes to allow small businesses to use this tax credit if they pool their resources and they have expenses relating to providing childcare through a third party. The law also makes some changes to the educational assistance program. So it permanently extends the ability for employers to make student loan repayments on behalf of their employees. And this is a benefit that was set to expire next year. And the new law sets the limit at $5,250 annually And these payments that are made by the employer on behalf of their employee are excluded from the employee's income. And that amount also is indexed for inflation. And last, the new law also permanently expands the paid family and medical leave tax credit that was set to expire at the end of 2025 as well. The new law expands this credit by allowing employers to claim the credit on a percentage of their premiums that are paid for insurance policies that provide paid leave as well. So yeah, those are the three kind of main fixes to the employee benefits tax credits.
And what I'm going to add to what Nick just said very quickly, a lot of my clients are closely held businesses, and they're always looking for additional benefits that they can offer to their employees. And the educational assistance programs, I have a number of clients who offer that. It's very well regarded by the employees, but it's hardly ever taken advantage of, interestingly. So between the educational assistance program changes and what Nick mentioned earlier about the employer being able to contribute up to $2,500 to those new Trump savings accounts, those are 2 points that I'm going to be talking to a lot of my closely held business owner clients about potentially incorporating them into their workplace benefits.
Great. Thank you both for all of that information. It was a lot to digest. And as we said at the top, we're looking to do this as a series. So please take a few minutes when we wrap up to let us know what you're most interested in hearing about next, and we'll take another deeper dive as we start getting some guidance from the regulatory agencies that'll help us circle back on some of the things that we even talked about today, hopefully with a little more detail and a little more ability to really explain how we're doing that. One of the things that I think we should point out is, and I noticed in both the chat and the questions, the Q&A section, we were getting questions. We are putting together a frequently asked questions document where we'll provide both the questions that you've asked, as well as the answers to those questions to the extent that we can. Again, waiting on guidance on a lot of these provisions. If you use the chat feature, I know you weren't able to see the questions that your colleagues were dropping in there. Again, we're going to put together a document. We'll make sure that you have all of that information and get it out to you. We can go ahead and flip to the wrap-up slide. We'll get you guys out of here. We do have a number of member-only resources. Everyone who's attended this webinar will receive a copy of the slide deck and a copy of the recording of the presentation. But we do have additional resources. For example, we have a very detailed analysis of what the new law does. We also have in that chart what the provisions were pre-enactment and then post-enactment, so you sort of know what the changes are. It'll have those effective dates because some of them come into effect at different times than others. We'll try to provide a timeline on that as well once we get the frequently asked questions document together. But please, so if you're not a member, join today. You can do that and learn more about NAIFA by scanning the QR code on the screen. With that, I will give my sincere appreciation to both Nick and Kathleen for taking the time today and really sharing with us not only what has changed, what is permanent, what is still temporary, because there are a good number of the provisions that still expire, and more importantly, how you can actually use those provisions with your clients to start those conversations to help them put in plan financial plans that work for them, their families, and their businesses, their workers. So thank you very much. Have a wonderful day.